Welcome to the fourth lesson of Enterprise Quality Management course. In this lesson, we're going to cover the fundamentals of management and leadership. Then we'll link the learned concept to the role of the quality manager. We will also we'll also learn how managers make decisions, plan, measure, and control performance. We believe that it's not enough to provide a job description of management tasks and assign it to a person to execute them. This will almost always result in failure. It's important for a department manager to understand all business functions in order to interface with other departments in the organization. He or she must be able to speak the same language and have the skills to make decisions aligned with the overall business strategy. What are the lesson objectives? And in this lesson, we'll try to answer 8 questions. What is management? What are management goals? What are the levels of management within an organization? How strategic decisions are made? How to align management plans? What is the management process? We'll try to answer what are the management functions and what are the necessary leadership skills. So what's management? The definition of IIM, or International Institute of Management, is that management is the art and science of acquiring, organizing, and developing resources to achieve objectives. Objectives can be long-term objectives like having an annual growth rate of 15% over the next 5 years or so. Or they can be short-term objectives like building a house in the next 6 months. It's important to note that the primary purpose of management is to create a suitable environment for attracting, developing, and directing people's efforts towards achieving business objectives. There are generally 3 levels of managers within an organization. The first level managers, middle-level managers, and top managers. Depending on the size of the organization, managers can be classified into like the aforementioned 3 levels. Top managers tend to have titles as CEOs, general managers, and presidents, and normally they manage a profit center. Middle managers, they have titles as vice presidents, department managers, and they normally manage cost centers. First level managers, they normally supervise the work, and they have titles like project managers, team leads, and supervisors. Example of middle managers would be HR manager, accounting manager, finance manager, and so on. As for the reporting hierarchy, of course, the team always reports to the project manager, who in turn reports to the department managers, who in turn reports to the CEO. The CEO in turn reports to the board of directors, who also reports to the investors. In small enterprises, sometimes a manager might function at more than one level. So one manager can act both as the president, the vice president, as well as the project manager. Decision making. How managers make decisions? They first research the environment, the business environment, to determine the driving forces. Then they try to forecast trends to define the supply and demand. Then they identify the challenges and opportunities to overcome the threats and capitalize on upcoming opportunities, business opportunities. Finally, they analyze the playing forces and evaluate available alternatives or courses of strategy. Let's take a look at an example of the environmental trend analysis tool used for managerial decision making. This tool is also used for opportunity and risk management analysis. The tool tabulates the 6 driving forces that's normally considered in strategy decision making, and they are mapped against 5 parameters, decision parameters. The driving forces are economic, political, legal, demographic, cultural, and technological. The parameters that are used for decision making or for forecasting a trend is the trend, the size of the trend, the timing of the trend, the probability that it will happen, and the impact, how it will impact the market and impact the business. Let's take a look at an example for each one of the driving forces. An example of an economic driving force or a trend is the increase in interest rate. And how would that affect the housing market if you are in the construction industry? Obviously, if the interest rates is increased, it means that the financing available for the consumers to buy houses is going to become more expensive, and the monthly payment to meet the mortgage is going to be higher. So this will exclude the lower income consumer segment, and therefore will reduce the demand in the market. As a manager, you will have to adjust or adapt your resources to meet the demands, the lower demands. Another example of economic impact is the recession. A recession might affect or impact certain industries, but not others. If there's a recession, luxury items there will be less demand on luxury items, or less demands on technology products like IT projects. But at the same time, it would not affect the healthcare sector, because people will always get sick, and they always need healthcare and medicine to take care of them. Another example is the political. If a political party known for their policies in promoting or increasing taxes, if they come to power through election, then businesses realize eventually that the taxes will eat away from their profits. So this also takes into consideration if you are expanding into a new market and the hospitable environment have higher taxes, so you might have to evaluate your profits after the taxes before you decide to see whether it's worth it to enter into that market or not. Legal environment or legal driving forces. An example of a legal driving forces and the impact it has on the industry and the business is one example is the scandal or the infamous scandal of Enron, the Enron fraud. This resulted in a major restructure of the financial liabilities and reporting by the U.S. Financial industry, especially with regards to public companies, and introduced a new governance act called Sarbanes-Oxley. Now, to comply with this act and avoid liabilities, you have to spend a lot of money on IT infrastructure, on process control, on financial audit. So during that period of implementation of Sarbanes-Oxley, you're going to introduce an additional cost that's going to eat away from your profit too. So this will, of course, impact your budgeting. Demographics. An example of demographics driving forces is the rise of the baby boomer generation. And basically is the relative increase in the number of senior citizens compared to the young population. This, of course, would let businesses provide more services to the senior community, more to their health needs, more to their taste, than it would be for a market where the population is more of a younger population. Cultural. Culture is the trends that has to do with people taste, like change in taste in music, for example, from jazz in the old times to rap in the current time. And finally is technology and how it impacts business and how it impacts your planning as a manager. One very good example to give is the internet. With the introduction of the internet, you provide access to information worldwide. You provide access to markets worldwide through e-commerce. At the same time, you probably gonna see this same distance learning course provided or broadcasted over the internet, which is an example of how a technology impacts industries like education. This slide illustrates how CEOs make decisions for the entire enterprise. So you think of it more as enterprise business planning. The organization research, market research, and market intelligence, as well as the organization knowledge and skills, determines the mission of the business or the mission of the company. The mission sets and the mission, an example of the mission is what markets we want to be in, what business we want to be in. This mission sets the objectives. And objectives are achieved through the 7 key business functions, including legal, finance, human resources, research and development, supply chain management, production, and marketing. Now, of course, these resources are limited. These functions, how well you execute your strategy, is limited by the internal resources and culture, as well as external factors like pests and competition. These objectives are achieved through functions, the 7 key business functions: the legal, finance, human resources, research and development, supply chain management, production, and marketing, which is limited by the company internal resources, like how many people you have, how well they know the technology, and culture is how well they can adapt to change. Can they change directions with the change of external market factors or internal changes? Other limitations or constraints to executing the business strategy include external factors like PIST, and PIST is an acronym for political, economic, social, and technological. Additionally, you are limited in the execution of your strategy to your competition, how strong it is, how would they react to you. If they decide to reduce their prices, you might have to react by reducing your own prices to remain competitive, and thus will reduce at your profit margin. In order to compensate for the loss in your profit margin, you might have to enter a new market to compensate for the losses in the profit. Strategic fit. One very important decision-making parameter is the strategic fit. Before you make a decision, you see how, before you make a decision about entering a market or hiring staff or introducing a product or partnering with someone, with another company, you have to see how this product or this partner helps you in achieving your goals and objectives. For example, if you want to partner with another organization, you may want to consider the SWOT analysis model. And SWOT stands for strengths, weaknesses, opportunities, and threats. Threats and opportunities has to do with external factors like the environment. We mentioned already the economic as well as the competition. Your strengths and weaknesses. An example of strengths and weaknesses is how well educated is your workforce? How strong are your products compared to your competition? Your reputation and brand? How advanced is your technology and R&D department? Your public relations skills, the price of your products, marketing, administration, and financial resources. A little bit more about opportunities and threats include examples of market trends, market entry and exit barriers, entry of or exit of major competition, market demand and supply, changing technology, introduction of a new legislation, internal resistance to change, and economic factors like interest rates, tax, and inflation. Management logic. Management logic. What is the most important management decision criteria? The answer to this is simple. The risk and reward or return on investment. Return on investment can be defined as the ratio of profit to cost. If you're going to make more money than you're going to invest, chances that you may want to go into this new venture or execute the project. If you think that you are not going to be able to return, you're not going to make enough profit, then chances that you're not going to invest in this project. That, of course, is limited with time too. That's the payback period. You may be able to say if you invest €100 and you can get that in you can get €120 in say 1 month, then that's a great investment you might want to consider. But if you invest the same amount, €100, and you're going to get €120 after 2 years, that wouldn't be a good investment. That leads us to the opportunity cost. It's important when you're calculating return on investment to consider the opportunity cost, not only the direct cost, but also the indirect cost. Let's take a look at an example of a manager deciding to go for a full-time MBA or Master of Business Administration program versus going for an accelerated distance learning executive education program. In the first option or first alternative, the cost of tuition and books is about $40,000 or 40,000 euro for our European audience. And this is calculated at 2 years at a cost of $20,000 per year. The opportunity cost also, when a manager has to go and get an MBA, a full-time academic MBA, he or she must leave work to attend the courses. And if you assume that a manager makes per annum 60,000 euros, then for 2 years of MBA program education, he's going to lose an income of 120,000. So the total cost of going for a full-time MBA is actually 160,000 euros. Now, let's compare that to the executive education program via online distance learning. If you take the accelerated option, you have tuition and book cost of about 20,000. That's the cost of 1 year. And the opportunity cost of loss of wages, since you are taking the course via online distance learning, you do not have to leave work. Therefore, your loss of wages would be zero, and your total cost would be actually only the 20,000, the direct cost of the program. Now, let's calculate the return on investment. Is it worth it to go for an MBA, or is it worth it to go for an executive education? If you calculate the return on investment from the cost from a previous slide, we have the academic MBA. The profit you're going to make is the salary after the MBA minus the salary before the MBA. So assuming that you get a raise from 60,000 to 100,000 euros per year, so you're making a profit of 40,000 per year. So the cost of MBA, since the cost of MBA is 160, your return on investment would be 40,000 divided by 160,000, that's 25%. That means your payback period is 4 years. So in 4 years, you'll be able, with the increase of your salary, you'll be able to pay all your expenses for going for an MBA education program. Now, that's a good investment, but when you make an investment, you also compare investment with other opportunities, and that's what we call the cost of lost opportunities. So let's take a look at another option. Another option is to go, if you calculate the executive education, so the profit you're going to make as a manager, you'll gain the knowledge, but at the same time, and your salary will increase from 60,000 to 100,000, so you'll make a profit of 40,000, the same thing. And your cost is 20,000. Notice the return on investment is significantly higher. 40,000 divided by 20,000 is 200,000. So your return on investment is not 25%, but 200%. This means your payback period in 1 year after you complete your first year of education program, you're not only going to get payback in the first year, you're going to also make a profit of 100%. Obviously, this leads the manager to make a decision to go with the executive education program. So this is an example that shows whenever a manager is faced with multiple alternatives, whether it is with introduction of new multiple products or introduction or partnering with multiple partners or entering new markets, he or she must always consider the return on investment and the cost of lost opportunity, and of course in relation to the time that he or she is expecting the payback period to be. So let's take a look at the management process and how managers manage. This slide illustrates IAM Rapid Management Model. And RAPID is an acronym for research, analysis, plan, implement, and develop. Let's talk a little bit more about the activities that's involved or the functions of each of these steps. For the research, of course, you research the forces of both the internal forces and the external forces in play in the market. Then you do, of course, opportunity analysis. You formulate, the third step, you would formulate the strategy and develop programs and project plans. The third step, you would coordinate and implement those plans. You would monitor and control the projects. And the final and fifth step is to develop or adapt, optimize, and fine-tune the organization or business for growth and change. The performance of the organization, or lack of it, is dependent on management skills in planning, organizing, controlling, and motivating the staff or the team. Planning function includes activities like integrating strategies, initiatives, programs, plans, and project results together from different departments. Organizing activities includes setting up resources and staffing, as well as training them to achieve objectives. Controlling includes the establishment of measurement and monitoring system to track the progress of the work and take corrective actions when required. Finally, motivation, and this has to do more with leadership skills, the motivation of people, where you exercise leadership skills in order to motivate your team to work to the best of their ability and function smoothly together as part of a team. Let's focus a little bit more on planning. This slide illustrates the complexity of planning inputs. A business plan normally consists of 7 sub-plans or 7 sub-plans: the marketing and sales, risk management, finance, human resources, production and operations and production, and of course supply chain management. Because of the lack of space in this slide, we included the supply chain management inside operations and productions. So what kind of business planning input is taken into consideration when conducting enterprise-wide planning? For example, in marketing and sales planning, you would have to define customer needs. You will have to demand forecast and conduct competitive intelligence to understand your strengths and weaknesses versus your competition. With risk management, you would have to understand the legal environment and work on minimizing legal liabilities and protecting your assets. With insurance, you might also want to consider insurance for the protection of your assets against disasters and against also legal liabilities. The other risk management item you may want to consider is the business continuity and disaster recovery, just in case there is an earthquake or a flooding, depending on where your business is located. The finance planning focuses on cost, revenues, and profits, as well as on the control of capital expenditure and operational expenditure. The human resources planning include the labor market conditions, the staffing level, and the training capacity. For the operations and production, you have the supply chain management. You provide plans regarding the quality of procurement or purchasing of materials from your suppliers, and you make plans for storage capacity, material availability, machine standards, and inventory levels. For the R&D plan, you will have to provide not you, basically the managers of each department will have to provide plans for new products, product design updates, and engineering specifications. All of this integrates into the business planning process and is overseen by the CEO. That, of course, explains why CEO get paid most in an organization, because of the scale, the scale and the scope of management they have to work on, and the expertise and the investment they have in their education to understand all the various aspects of each of these departments and related plans. Now, your role as a quality manager is to identify the quality controls for each of these quality controls, as well as the measurement metrics for each of these departments and the sub-process, including legal, insurance, CAPEX, OPEX, etc. An example of metrics would be the return on investment standard, the debt to equity ratio, cost revenues, etc. Other factors to be aware of is that normally departments and plans have conflicting requirements, and they normally compete for the budget, the annual budget available within an organization. Unfortunately, the decision to, because of the large-scale organizations, it's very difficult to control the quality of business planning, and therefore the decision of budget allocation across multiple departments or multiple projects within a department is dependent or based on politics and salesmanship. This is rather than merit of the plan itself. This is a fact of life you have to live in. You have to live with in an organization. In addition to the subject matter expertise in planning within a department, we recommend that you also develop your people and communication skills in order for you to achieve your department objectives within the organization. The 6 brothers of wisdom. In the earlier lesson, we did mention them. We did mention the 6 brothers of wisdom, but we didn't really elaborate on what they are or what they mean. The 6 brothers of wisdom actually is an adaptation of what's commonly known as the 6 honest serving men. In the beginning of Rudy Kipling's poem, The Elephant Child, the poem goes as follows: I keep 6 honest serving men. They taught me all I know. Their names are what and why and when and how and where and, of course, who. If we take this and apply it to management, to business management, actually this can be applied to the management of in any domain, whether it's a project management, whether it's a business management, or even life or personal management. So back to the business management, the what question asks questions about what are the objectives and information needed, as well as the results. The why is the reasons and the analysis of cause and effect. Why would you take that decision, or the cost benefit? The who is deciding on who is involved or who will get affected by such decision, and that involves the deciders, the doers, and the subjects. The where is deciding on where to implement this plan, or the venue of communication and execution if relevant to the project. And of course, there is always the when, which is the timing. And finally, there is the how. And the how basically helps you decide whether you're going to implement the project in phases or at once, in whether the approach is through evolution, taking longer time, or through revolution like restructuring or re-engineering. And of course, the how would also take care of the actions and the anticipated reactions for the new plan, as well as the backup and contingency plans. The planning hierarchy, as well as scale. There are 4 hierarchies of planning. The strategy, which is normally formulated by the CEO after taking the input of his executive team. Then his executive team will develop programs and initiatives to execute that strategy. And this is done at the mid-level management. And the third is, and after that, of course, the programs are translated into multiple projects that are handled by project managers within the organization. The project managers and project leaders will provide action lists for their teams for the as guidelines and as a way to coordinate as well as to organize the activities and efforts for each project. Let's take a look at another decision hierarchy we call the decision tree. A manager would always have to adapt his resources and organization to meet the changes in demand. Let's take an example of varying the output to match the demand level in case of an increase in demand for a product. So the manager has options to vary the production machines by introducing new machines, buying new machines, or by working the machines more time, or by considering automations to speed up the production. The manager can also vary the workforce, and in an upturn cycle for the demand, the manager has an option to hire contractors or hire new employees, pay overtime for the employees, subcontract someone else to help with the production, or even outsource a certain line of products. In a downturn cycle, the manager would have to take a decision to reduce the working hours by probably sharing jobs or laying off staff, or letting the employees go on vacations during the downturn cycle. Management alignment. How can you, as a manager, how can you align and integrate all objectives and activities across an organization? As a senior manager, you can use the following alignment model. This model is developed by IAM, and it follows the analysis, design, planning, and execution flow. We'll take a look at, in the table, we'll take a look at the phases that you go through in order to align your operations and planning. So first you start with opportunity analysis, whether it's fit, like we mentioned earlier, whether it's fit to your organization and department. So you'll conduct customer needs assessment. You'll conduct capabilities and core competencies of your organization and staff. You'll understand and size market characteristics. After you have done the analysis, you will design the corporate strategies by probably entering into, by formulating new market strategies, or by introducing new products and services. Now, how do you translate that with so much information and so much task, how do you translate that into multiple departments? The trick is to focus really on what we call competitive priorities. And for a product, you cannot possibly have everything. You can be at the best at everything and in all aspects. So you have to focus on what you can do best, and of course taking into consideration your limitations in terms of skills, resources, etc. So that we call is competitive priorities. Prioritizing your strength when you introduce a product to a market. An example of a product competitive priorities would include cost, so you'll try to reduce your cost. Time, you try to reduce your production time. Maybe you have very strong skills and good quality infrastructure, so you'll focus on quality. And of course, flexibility in case your product is, your design allows you flexibility in features, in adding new features, and in customizing your product or services to your clients. Other examples for marketing competitive priorities include focusing on price, on product or place, which is normally the channel, and promotions. For finance is probably focusing your competitive priorities on raising capital or investment. Your return on investment may be better than your competition. Maybe you can minimize the cost of capital by getting a better interest rate from certain suppliers. For HR, it's how your strength in hiring, retaining, and developing the best people, and minimizing employee turnover. For production, your competitive priorities would be cost, time, quality, and flexibility. We already mentioned that. And for IT, it's your automation, reporting, and what we call FCAPS. And FCAPS stands for fault, configuration, accounting, performance, and security of your IT infrastructure. Other competitive priorities you will consider is your legal abilities to protect your assets and mitigate liabilities. You would notice that this model uses a closed loop, meaning that your competitive priorities will always be updated on an annual basis along with the gained new knowledge, introduction of changes in the environment, in market environment, introduction of new products, new competition, etc. Management alignment. Let's take a look at an alignment example for growth planning. The manager has to set an objective. Let's say that objective is 20% return on capital or 20% return on investment. This means you have to generate $100 million, for example, in profits, which of course requires you having to make sales of $50 million in quarterly sales, which requires a quarterly sales of $50 million per quarter. This translates into having to sell 100,000 units per quarter. Now, in order to achieve these numbers, you might have to enter into a new market. You might want to hire new retailers or resellers. Internally, you will have to hire 3 new sales representatives and probably launch, say, like 4 new national TV ads on quarterly basis. Of course, these new activities for growth in your revenues and profit require additional investment. And let's say the investment is $10 million. The key to success in business planning and management alignment is to be able to balance between the to accurately forecast your target and the required investment. Because if you invest more than $10 million, more than the required $10 million, you might risk reducing the profit. If you underinvest less than $10 million, you might not be able to achieve your revenue targets, which will, of course, will affect your 20% return on capital objective. With this slide, we will finish the first part of management and leadership lesson. We will continue the second part in the next episode or next lesson. So in following up on the first part of management alignment through planning and controls, I am developed a planning evaluation checklist to help managers in their planning efforts. The key questions to ask yourself as a manager is your plan research-based? Is it based on tested facts and assumptions? Is it timely? It's not too early or too late, for example, to enter a market. The implementation approach is in proper phases or at once. Did you consider the strategic fit? Does the allocated resources or acquired resources support and complement your own strengths and weaknesses? Is it practical? Are your goals achievable? Is it complete? Were your planning comprehensive? Did you take into consideration the play of all the forces involved? Is your plan integrated? Is your enterprise business plan integrated? Do you conduct projects across the organization that are duplicates and therefore result in a waste of resources and efforts? Or is it well integrated and well communicated across departments? Is your business plan aligned? Are your goals and plans leverage each other's strength and do not conflict with each other, and in fact actually complement each other's weaknesses? Did you consider the cost-benefit analysis? Did you conduct a cost-benefit analysis, and do you have a justification of choice? That includes, of course, the strategic fit, the cost of lost opportunity, and the total cost of opportunities. An example of cost-benefit analysis would include the use of return on investment decision model that we have explained earlier. Did you conduct risk management? Do you have contingency plans? Did you include a change management plan within your new initiatives and programs to include communication, persuasion, incentives, as well as training and education? So with the previous slide, we completed the one of the main functions or tasks of managers. In this slide, in the following few slides, we're going to focus more on organizing or organization skills for managers. There is a classical story of 4 people that helps illustrate the value of organization or the importance of organization. These people are called everybody, somebody, anybody, and nobody. There was the story goes as follows, and it's quite popular in the business world. There was an important job to be done. Everybody was asked to do it. Everybody assumed somebody would do it. anybody could have done it, but nobody did it, somebody got angry because it was everybody's job. This story illustrates basically the lack of proper organization. Good organization means well-defined management structure, roles, and communication lines. Here's a mini checklist for managers of best practices when they design and develop their organizations. Always choose the right person for the right job with adequate competence and abilities. Have clear responsibilities and authorities with a written job description. Establish adequate communication lines. The communication methods should be clear, open, and bidirectional, meaning the information flows go both ways, from lower management to higher management and vice versa. Also, communication methods should be adequate, both internal communication lines as well as external communication lines with your partners, suppliers, and customers. There should be function independence, meaning there is no conflicting responsibilities or overlap of duties. The responsibilities are appropriate with the authority given to the manager. There are defined departmental and functional interfaces with other units, and are defined external interfaces with other organizations. Finally, you'll have prepared documentation and knowledge base of the organization that's available to always give to new recruits or new partners. Functional structure. An organization structure can be based of three main types: functional, geographic, or a matrix. The functional structure organizes the various departments along the lines of classical business functions like HR, marketing, and finance. The CEO acts as the general manager, and the department managers provide communications and reporting, as well as planning assistance to the CEO. The second organizational structure is the geographic structure. The geographic structure organizes operation based on geographic markets, with choice of centralizing the core administration functions like marketing, finance, HR, supply chain management, etc., while distributing the sales as well as the accounting function to district staff. Each geographic market is normally a profit center. So a multinational organization tends to organize their operations into regional geographic areas. For example, if you have an international company, you would have a general manager for North America, a general manager for Europe, Middle East, and Africa, another one for South America or Latin America, and the third one is for Asia and Australia. The matrix structure. The matrix structure is ideal for project-based businesses like contracting, or for implementing enterprise-wide project implementation of strategic initiatives. In this structure, the corporate resources are available for all the projects, and projects are conducted on and the management of each operation is managed by project managers. So you'll have legal assisting project A, project B, and project C, the same with finance and marketing. This is an ideal structure. This is an ideal business structure for industries like contracting, for example, where they have major projects and each project has its own profit and loss calculation. It has its own legal contractual requirement and other resources. Restructure. Managers need to recognize that strategy and structure often change or evolve in predictable patterns. Here is some guidelines to match structure to strategy and some of the options. A manager has options to restructure to emphasize and support strategically critical activities. He or she can re-engineer strategic business processes. He can downsize or upsize the organization by laying off staff or hiring more staff. He can outsource some of the operations to more competent or more cost-effective subcontractors or service providers. Or he can choose to allow managers to do self-management and basically execute management by objective model. Of course, the final option is to keep the structure as it is and just implement a quality initiative or management best practices initiative to increase efficiency and effectiveness. Organization and quality manager. Let's take a look at the role of quality manager and quality professionals within an organization. Quality assurance and quality control professionals will work with all departments but will report to the quality manager, who in turn who works with his peers, production manager and other managers, but reports to the chief operation officer. Now, here's a quick quiz question. Quick quiz. Now that you want to implement a quality initiative within an organization, what is the best structure in your opinion? The answer is matrix. The matrix structure is the best way because it involves multiple departments and multiple managers. Now, after you establish a quality management initiative or quality management system within your organization, if you want to maintain it, what would be the best organization structure? The best organization structure, the answer to this is, of course, having a functional structure whereby the quality manager manages all the quality activities. Here's a brief job description of quality manager role. Like we said, the quality manager reports to the CEO. His or her responsibilities shall be, he or she shall be responsible for planning, implementation, monitoring, and reporting of the enterprise quality management system, as well as the performance of the organization as it relates to quality management system. The job description for quality professionals will be to report to the quality manager and shall be responsible for the coordination and execution of all the quality assurance and quality control functions of the organization. The quality manager role is to lead quality initiatives, build quality systems, provide staffing and training, integrates the quality activities across multiple departments, and conduct a regular assessment of the performance of the quality management system. The quality manager is basically the quality initiative leader and the champion within the organization. So the quality manager role is to plan the quality implementation within the organization, design quality procedures, establish quality controls in each department and for each process, try to prevent errors as much as possible through previous learned lessons, and following best practices. Work on continuous improvement of the processes within the organization. Train the staff as well as the managers on the importance and the best practices of quality implementation. Maintain the quality documents and help organize the internal and external audits of the quality system as well as the certification. The quality professionals will assist the quality manager in documentation maintenance, coordination and liaison with auditors as well as with other departments. Again, in the prevention of errors, in inspection, in the monitor and update of necessary quality procedures. The quality management or the quality manager skills include the subject matter expertise on quality as well as on business process improvement, having critical thinking and problem solving skills, strong project management skills, must be business savvy in order to be able to communicate and speak the same language with other departments, has cross-functional operational experience so he can smoothly work together with each department. We've covered planning and organizing tasks. The third task is controlling. Controlling starts with planning, then the implementation of the plan, the monitoring, reporting, analyzing, and taking corrective action. This is called the quality loop. And the control activities occur with the monitoring and corrective change. The management control loop starts by first defining the process, establishing performance metrics, conducting the performance measurement, analyzing deviations, and taking corrective actions, and then remeasure the performance. Management control. In the previous slides, we talked about how objectives translated into what does objective means and what do they require within the organization and how they are translated into targets. Now, the control of the business management occurs through management reviews. The manager will always review their objectives were realistic or not, if they are achieving their profits on quarterly, if they're achieving their revenues on quarterly basis, and if there are any deviations to probably reduce the investment budget or increase it. Management reviews ask always, why do we need to do something or not do it? When do we need to do it, and how? Management reviews of quality always reviews the resource allocation. Is it adequate? Follow-up action items, the audit results, quality records, and performance metrics. Managers also review stakeholder complaints, and then based on that, they will take corrective actions and prevent future errors or defects from occurring. They review the training levels and conduct training as needed within the organization. They review process bottlenecks, whether it's a manufacturing process or a business process, and minimize those. They review the efficiency of the system and its effectiveness, of course. The fourth and last management function is motivation, and this has to do with the leadership skills. It's important to realize that leadership skills is about team building. It's not about knowing it all. It's rather working with your team and supporting them, at the same time getting help from them. It's about collaboration. Leadership skills not only has to do with having good relationship with your team, but also with other teams in other departments, and collaborating with other departments to improve efficiency and effectiveness of the business processes. Yes, it is important to be a manager. It's nice to be important, but it's more important to be nice. So being courteous is very important for your leadership skills in order to win support from your teams and peers. Always remember that positive reinforcement work much better than negative reinforcement. So rather than criticizing the employees all the time, try to find ways to complement their strength, and if there are challenges that they're facing, always work on training them, coaching them, and mentoring them. Being smart versus being right. Smart leaders realize that although sometimes they are right, they do not involve in argument and blame, because it's going to be a waste of time and only puts the other person in defensive. So sometimes being smart is just letting go of the issue and picking your battles and focusing on what's really important within the organization or the project. Conflict management. A leader must have negotiation skills and must be able to resolve the conflict in a win-win situation. Here's an example of good versus bad leaders. Of course, good leaders tend to be courteous rather than inconsiderate. They are constructive rather than being critical, objective rather than being subjective, assertive versus being aggressive. This is also very important. The difference between assertive and aggressive is that aggressive tends to attack the other person, while assertive tends to stress your rights and making sure that nobody compromise your needs, but it is not about attacking somebody else. Supportive versus demanding, and again, of course, empowering by allowing your team and your subordinates to take decision rather than microcontrolling, like we said in the first lesson. It's not about breathing on your staff's neck. To be a successful leader, you need to lead by example. You have to have professional ethics in order to win the respect and the support of your peers, as well as your team members. So you should be impartial. You should not favorite one partner over the other, or one subordinate or team member over the other. The only criteria for reward should be the performance, the individual performance. A quality manager should be independent. He or she should give their opinion honestly, without being influenced by relationships or other factors. Integrity must be discreet, respect confidentiality, respectable, and trusted. And the way to be respectable and trusted is also to respect others and to trust them. Lesson summary. In this lesson, we defined what management is. what are the goals of management, the different types or levels of management, the management decision-making process, how managers take strategic decisions. We focused more on management alignment, how to align plans and goals within the organization and across different departments. We focus on the management process, and we explored the details of management functions. And finally, we listed critical skills for the leadership and management. The online resources for management and leadership best practices can be found at iim-edu.org. For more information on this course, for questions and answers and reference text, please go to UNINETTUNO website and click on MedNetU project. Thank you, and see you with the next lesson.